Hey everyone, and welcome back to the channel. Today, we're diving deep into the world of gold trading, specifically XAUUSD. A lot of beginners jump into gold thinking it's a quick way to make money, but they often get burned because they don't know the hidden rules of the game. So I'm here to share the crucial truths that most gurus won't tell you. If you're serious about trading gold, you need to hear this. First, let's talk about timing. Gold isn't active 24/7. Its biggest moves happen during specific hours. The real action kicks off during the London session and intensifies when the New York session opens. That overlap from about 8 a.m. to 12 p.m. Eastern Time is prime time for gold volatility. This is when the big banks and institutions are most active. Also, keep a close eye on major U.S. news releases. Gold goes wild during these announcements. If you're trading in the middle of the Asian session, you're mostly just watching paint dry. Focus your energy on the London and New York sessions for the best opportunities. Next, you absolutely must understand gold's relationship with the US dollar. They generally have an inverse relationship. When the dollar gets stronger, gold tends to fall, and when the dollar weakens, gold tends to rise. This means you have to be a news junkie. The most important events to track are Federal Reserve interest rate decisions, CPI inflation data, non-farm payrolls, PPI, and FOMC meetings. Before you even think about placing a trade, check the economic calendar. Trading gold without knowing what the Fed is doing is like driving blindfolded. The dollar is the other side of the XAUUSD pair, so its strength dictates. Now let's talk strategy. A massive mistake beginners make is getting lost in the noise of lower time frames like the 1-minute or 5-minute charts. Before you do anything, you need to zoom out. Look at the 4-hour, the daily, and even the weekly charts. What is the overall market direction? Is it in a strong uptrend, a downtrend, or is it consolidating sideways? You want to trade with the bigger trend, not against it. Trying to catch the exact top or bottom of a strong trend is a recipe for disaster. Let the higher time frames be your guide, and use the lower time frames only for fine-tuning your entries. Always swim with the current. Let's get serious about risk management. Gold is not like other forex pairs. It is notoriously volatile and can move 100 pips in a matter of minutes. If you don't manage your risk, you will blow your account. It's not a matter of if, but when. The rule is simple. Never risk more than 1 to 2% of your account on a single trade. Set a clear stop loss for every single trade you take, and don't you dare move it further away if the trade goes against you. A stop loss is your insurance policy. It's what keeps you in the game to trade another day. High volatility demands even stricter risk control. Flowing directly from that is the importance of position sizing. Because gold moves so aggressively, you cannot use the same lot size you might use for a pair like your USD. If you do, a sudden spike can wipe out a huge chunk of your capital before you can even react. Always start with smaller lot sizes when trading gold. Get a feel for its movement and how it impacts your P&L. You can always scale up later as you become more experienced and profitable, but start small, seriously. Protect your capital above all else. Your goal as a trader is to survive first and profit second. Smaller positions will help you do just that. Now, where should you actually enter your trades? Avoid trading in no man's land, which is the middle of a range. Gold respects key technical levels, what we call reaction zones. These are areas emociones supply and demand. Significant highs and lows on the 1-hour and 4-hour charts, and major liquidity areas where stop losses are clustered. Mark these zones on your chart. Wait for the price to reach these areas, and then look for a reaction. Does it reject the level? Does it break through and retest it? Trading from one key level to the next is a much higher probability approach than just randomly entering in the middle. Be patient and wait for the price to come to you. Speaking of patience, let's talk about the fear of missing out, or FOMO. Gold is the king of manipulation. It will often make a fake move to sweep liquidity. That means it runs stops above a high or below a low for making its real intended move in the opposite direction. Beginners see a big candle and jump in, afraid of missing the move, only to get trapped. The key is to wait for confirmation. Don't chase the first breakout. Wait for a candle to close above or below a key level. Better yet, wait for a retest of that level. If it breaks a resistance, wait for it to come back down. Test that old resistance as new support, and then enter. This simple act of waiting will save you from so many bad trades. Now, a special tip for beginners. Avoid holding positions during major high-impact news events. I'm talking about FOMC, NFP, and CPI. The volatility during these releases is extreme. Spreads can widen, and you can experience massive slippage, meaning your stop loss gets filled far away from where you placed it, leading to bigger losses than you planned for. Unless you are a very experienced trader with a specific news trading strategy, it's much safer to be flat, meaning out of the market and wait for the dust to settle. There'll always be another opportunity after the chaos. One of the biggest keys to long-term success is consistency. Stop jumping from one strategy to another every week. The internet is full of holy grail strategies, but the truth is, most profitable traders stick to one or two methods and master them. Whether you choose to be a breakout trader, a pullback trader, or a liquidity grab trader, pick one and stick with it. Refine it, learn its nuances, understand its strengths and weaknesses. Journal your trades, see what works and what doesn't, and optimize. A mediocre strategy executed with discipline is far better than a perfect strategy executed sporadically. Be a master of one, not a jack of all trades. Finally, and this is the most important point of all, control your emotions. Trading is a psychological game, and gold will test your mental fortitude like nothing else. The big, fast moves can trigger greed and fear. If you take a loss, don't immediately jump back in to win it back. That's revenge trading, and it's the fastest way to empty your account. Similarly, never hold on to a losing position, hoping it will turn around. Your analysis was wrong. Accept it, take the small loss, and move on. Discipline is your greatest asset. If you find yourself feeling emotional, step away from the charts. A calm and objective mind makes the best trading decisions. So, to recap, trade during London and New York, watch the US dollar. Analyze the higher time frames. Use strict risk and position sizing. Trade at key zones. Wait for confirmation. Avoid news if you're new. Stick to one strategy and master your emotions. This is the real foundation for trading gold successfully. It's not about finding a secret indicator. It's about discipline, patience, and respecting the unique personality of this powerful asset. I hope this gives you a much clearer and more realistic picture of what it takes to trade XAUUSD. It's a challenging but rewarding journey if you approach it with the right knowledge and mindset. Thanks so much for watching. If you found this video helpful, do me a favor and hit that like button and subscribe for more honest trading content. Let me know in the comments what your biggest struggle with gold trading is. Till next time, trade safe.